Wall Street is often called a casino, but unlike Vegas, they don't spin a roulette wheel, they spin equations. And one formula became their jackpot machine, Black Scholes. It turned risk itself into a product you could buy, sell, and weaponize, fueling billions in profits and opening the door to an entirely new marketplace. This wasn't just math on paper, it was the engine that transformed Wall Street into the most powerful casino on earth. So how did a single equation become powerful enough to create four multi-trillion-dollar markets? To understand why the Black Scholes formula was such a breakthrough, you first need to understand what options actually are. At their core, options are contracts, simple agreements between two people about what might happen in the future. And here's the thing, Wall Street didn't invent them. Options existed centuries before stocks, before trading floors, even before banks. Picture this. You're a farmer in the 1600s. You plant wheat in March, and you won't harvest until September. But there's one problem. Uncertainty. What if prices crash before you can sell? What if a good harvest floods the market and your profits disappear overnight? So you make a deal. A local merchant agrees to buy your crop 6 months from now at a fixed price. No matter what happens, drought, bumper crop, or price crash, your income is secured. He gets the wheat. You get peace of mind. That deal, that promise about the future, was the first version of an option, a simple way to trade risk. Fast forward a few centuries. The world's bigger now. We've got stocks, oil, currencies, and global markets running 24 hours a day. But the problem hasn't changed. The future is still uncertain. Investors wanted protection, a way to lock in prices, to hedge their bets, or sometimes to make bold predictions without risking everything. That's how options evolved into the ultimate financial tool, a way to control assets, manage risk, or speculate, all with a fraction of the money. So what exactly is an option? Let's simplify this. You find a house worth $500,000, your dream home, but you're not ready to buy yet. Maybe you're waiting for a loan or watching the market. So you make a deal with the owner. You pay them $10,000 right now, and in return, they promise to hold that price, $500,000, for 6 months. If the market goes up and the house is suddenly worth $600,000, you still get to buy it for $500,000. That's a $100,000 gain, all because you locked in the right to buy early. But if the market drops, you can walk away. You're not obligated to buy. All you lose is that $10,000 premium you paid up front. That's what an option really is. The right to make a move later, without having to make it now. It's financial control without ownership. Now, look at this graph. It gives you the perfect picture. On the horizontal axis, you have the price of the asset, the house, or in financial terms, the stock. On the vertical axis, you have profit and loss. The flat red line below the strike price shows your maximum loss, the premium you paid. Even if prices collapse, your loss is capped, but once prices rise above your strike price, in this case $500,000, the line starts to climb. Every dollar higher adds to your profit. At around $510,000, you hit break even. You've recovered your premium. And beyond that, your profit potential is unlimited. That's a call option, a bet that prices will go up. You're buying the right to purchase later at today's price. Traders use calls when they believe something, a stock, gold, or even real estate, is going to rise in value. But there's another side to this story, the put option. A put is simply the opposite bet. While a call makes money when prices rise, a put makes money when prices fall. Think of it like insurance. If you own that same $500,000 house and fear the market might crash, you can buy a put option that lets you sell it for $500,000, even if prices drop lower. So when the market falls, the value of your put goes up. It's protection, or for traders, a way to profit from decline. In the simplest sense, options are about trading uncertainty, buying and selling risk itself. But here's where it gets interesting. Before the 1970s, nobody knew how to price that risk. The market was chaos, pure gambling dressed up as finance. Originally, options were created for hedging like insurance. Farmers used them to protect crop prices. Airlines used them to lock in fuel costs. Investors used them to shield portfolios from losses. It was risk management, nothing more. But soon, people realized something dangerous. You didn't need to own the wheat, the oil, or even the stock. All you needed was a bet and a prediction of where the price would go next. And that's where Wall Street smelled opportunity. By the 1960s, option trading wasn't a niche idea anymore. It became a frenzy. Everyone wanted to bet on the future before it happened. But there was one big problem. Nobody knew what these contracts were really worth. One trader might sell an option for $100, another for $200, and neither could prove who was right. There was no system, No logic, no science, just rumors, instincts, and a lot of guesswork. It was like two people selling insurance on the same house, one charging $100, the other $200, but neither knowing the real risk of it burning down. Everyone was guessing, hoping their math or their luck wouldn't blow up in their face. It was gambling disguised as investing, until a small group of academics, Fisher Black, Myron Scholes, and later Robert Merton, came along with a radical idea. What if risk could be measured? What if uncertainty itself had a price? That single question would change Wall Street forever. Because what they built next was the formula that gave risk a number and turned finance into science. But before finance, there was physics. To understand how stock prices move, Fisher Black and Myron Scholes looked outside Wall Street to how heat spreads and how particles move randomly in nature. In the early 1900s, scientists studied Brownian motion, the random path of particles bouncing around in a fluid. At first, it looks chaotic, but over time, that chaos averages out into a predictable pattern, a bell curve, also known as the normal distribution. And a forgotten French mathematician named Louis Bachelier was the first to realize stock prices move the same way. Each tick is random, but the overall behavior follows mathematical order. Imagine a Galton board, the device where balls drop through pegs and always form that perfect bell curve at the bottom. That's the market. Every trader, every tick. Every decision random on its own, but together, they form a pattern that math can predict. Stock prices don't move in straight lines, they wiggle, fluctuate, and diffuse just like heat spreading or particles in water. That concept of diffusion became the heart of the Black-Scholes formula. They realized that just as heat flows from hot to cold, risk flows through markets in measurable ways. Their equation, the Black-Scholes partial differential equation, is mathematically identical to the heat diffusion equation used in thermodynamics. In physics, it predicts how heat moves through metal. In finance, it predicts how option prices evolve as volatility and time change. They literally took the math of heat transfer and turned it into a formula for money transfer. Let's rewind a bit. The path to this breakthrough didn't start in the 1970s, it began centuries earlier. In 1720, Isaac Newton, one of the smartest men alive, lost his fortune in the South Sea bubble. He later said, "I can calculate the motions of heavenly bodies, but not the madness of people." Even Newton couldn't predict market behavior. Then, in 1900, a French mathematician named Louis Bachelier became the first to apply math to markets. In his thesis, The Theory of Speculation, he treated prices as random walks, unknowingly laying the groundwork for modern finance. 5 years later, Albert Einstein mathematically proved Brownian motion, confirming that Bachelier had been right all along. Markets move randomly, but within predictable statistical patterns. So when Fisher Black and Myron Scholes began their work, they weren't starting from scratch. They were finishing a century-old scientific puzzle. They connected Newton's chaos, Bachelier's math, and Einstein's motion to build a model for the world's most chaotic system, the stock market. Here it is, the equation that built modern Wall Street. First comes the Black-Scholes partial differential equation. And after solving that, we arrive at the Black-Scholes Merton formula, the version traders actually use to plug in numbers and get the fair price of an option. It looks complex, but here's what it really means. C, the fair price of the call option. It's what the option should really be worth today. S0, the current stock price. What the asset is worth right now. K, the strike price. That's the price you've agreed to pay in the future. T, time to expiration. How long until the option expires? R, the risk-free interest rate. Basically, what you'd earn with zero risk, like US Treasury bonds. Sigma, volatility. It measures how unpredictable or wild the price movements are. And finally, N of D1 and N of D2. These represent the probabilities that the option will end up profitable, based on the normal distribution curve, the famous bell curve of probability. In simple terms, the formula weighs two competing forces, reward and risk. The first part, S0N of D1, represents the potential gain if the stock rises, the upside of owning the option. The second part, K multiplied by e to the power of negative RT N of D2, represents the cost of waiting, what you'd pay later, adjusted for time and interest. When you subtract one from the other, you get the fair present-day price of that risk. It's math doing what traders once did by instinct, turning uncertainty into probability. This formula gave markets a universal language. It meant anyone, anywhere in the world, could now measure, trade, and hedge risk as precisely as physicists calculate gravity or velocity. It didn't just explain options. It became the foundation of modern finance. Within a decade, it had created trillion-dollar markets, from options and futures to credit default swaps and structured products. In 1997, Scholes and Merton won the Nobel Prize in economics. Fisher-Black had passed away 2 years earlier, but his equation had already become immortal. All this math created power, but also danger. The Black-Scholes formula didn't just price options. It unlocked Wall Street's next obsession: derivatives, bets built on other bets, where even risk became something you could buy, sell, or weaponize. In simple terms, a derivative is a financial contract whose value is derived from something else. It doesn't have value on its own, it's linked to an underlying asset like stocks, oil, gold, interest rates, or even weather. Think of them as bets on bets. You're not buying the asset itself, you're buying a bet on how its price will move in the future. If the underlying asset goes up or down, the value of the derivative changes with it. It's a way to transfer risk from one person to another. Used properly, they make the system safer, but used recklessly, derivatives become weapons. They magnify risk instead of reducing it. By the 2000s, the global derivatives market had grown to hundreds of trillions of dollars, many times larger than the world's total GDP. And when things went wrong, as in the 1998 long-term capital management collapse or the 2008 financial crisis, the same math that was meant to protect the system nearly brought it down. Derivatives made the world safer until they made it explode. From casinos to Wall Street, from roulette tables to quantum models, the same math decides who wins and who loses. The difference isn't luck, it's understanding the equation behind risk. The Black-Scholes formula didn't just change how we trade, it changed how we think about uncertainty itself. It proved that risk could be measured, modeled, and even sold. And in doing so, it turned the markets into the biggest casino ever built. The ultimate stage for the money game. Because once you understand how the game is played, you'll never look at money the same way again. The next case opens a new chapter in this financial story. You'll understand when you click it. Subscribe to The Money Game. Because the truth behind the money never shows up in the news.